It was Friday, January 30th, 2026, 4 p.m. Eastern Time. One sentence came out of the White House, just one, and in the next few hours, silver lost 31.4% of its value, the single worst day for the white metal since March 1980. Gold dropped nearly 15% in 48 hours. Billions of dollars evaporated from precious metals markets before most investors even understood what had happened. What did President Trump say? He announced his nominee to lead the most powerful central bank on earth, the United States Federal Reserve. His choice? Kevin Warsh. 2 words, 1 name, and the entire precious metals market cracked open. But here is what nobody is telling you. Behind this terrifying collapse lies a story far more complex and far more important than a simple price crash. Because Trump did not just name a Fed chair that Friday. In the weeks surrounding that announcement, he also launched something called Project Vault, a $12 billion government stockpile of the exact metals that just crashed. Think about that for a moment. The president's announcement destroyed the paper price of silver. And then his administration began stockpiling the physical metal. If you do not understand why those two things are connected, you are watching the wrong market. Part 1. The Warsh Shock. What Trump actually triggered to understand what just happened to silver, you need to understand the story that the market had been telling itself for 12 months. Throughout 2025 and into early 2026, investors around the world had one shared fear, that President Trump would appoint a loyalist to lead the Federal Reserve, someone who would bend to political pressure, flood the system with cheap money, crush the dollar's value, and ignite inflation. That fear drove massive capital into safe haven assets. Gold nearly doubled in 12 months. Silver exploded 150% in a year. By late January 2026, gold had crossed $5,600 per ounce. Silver touched $120. The entire rally was built on one central bet. The dollar was going to be destroyed by a politicized Federal Reserve. On January 30th, 2026 at 4 p.m., Trump shattered that bet in a single announcement. Kevin Warsh is not a loyalist. He is not a money printer. He served as a Federal Reserve governor from 2006 to 2011, placing him at the center of policymaking during the global financial crisis. He was instrumental in designing emergency liquidity programs. He resigned in 2011 specifically because he opposed the second round of quantitative easing, the money printing policy that investors feared Trump would demand. He publicly pushed back against the Fed being too slow to respond to inflation in 2022. Warsh is what Wall Street calls a monetary hawk. He believes in a smaller Fed balance sheet, tighter money, and a stronger dollar. When Trump named him, the market's worst fear evaporated instantly. The dollar surged, and everything that had been bought as a hedge against a weak dollar, gold, silver, Bitcoin, was sold immediately and violently. Silver crashed from over 115 to an intraday low of 80.55. Gold settled at 4,745.10, down 11.4% on the day, its worst sell-off since 2013. Silver's 31.4% single-day decline was its worst since 1980. Mining company Pan American Silver saw its shares crater 25% intraday. First Majestic Silver and Hecla Mining posted double-digit losses. The volume surge was so extreme it triggered multiple circuit breakers on silver ETFs. A market strategist at Baird captured the mood perfectly in one line written publicly on X. Silver is just GameStop in 2026. The crowd that had chased the rally at the top was now all sprinting for the exit at the same time. Now stop, because here is where this story gets genuinely important. The market sold silver because it believed Warsh would tighten monetary policy, raise the dollar, and make precious metals less attractive. But multiple analysts immediately began asking, did the market misread Warsh entirely? The same man who opposed money printing in 2011 had spent 2025 publicly shadowing Trump on monetary policy, criticizing the current Fed and signaling openness to rate cuts. He also wrote a scathing op-ed in the Wall Street Journal in November 2025, titled "The Federal Reserve's Broken Leadership," aligning himself with the administration's frustration with Jerome Powell. Analysts began noting that Warsh's actual framework, quantitative tightening combined with front-loaded rate cuts, is more nuanced than simply hawkish. He wants a smaller Fed balance sheet and lower interest rates in the second half of 2026. Those are not contradictory positions, but they are not what the market priced in during the panic. The confirmation timeline positions Warsh to assume Fed leadership by mid-2026. And when he does, with rate cuts expected in the second half of the year, gold and silver will once again become significantly more attractive. By Tuesday, February 2nd, just 2 trading days after the crash, gold had already risen more than 3% to $4,820. Silver surged 5.3% back to $83.50. The panic lasted 48 hours. The structural story did not change at all. Now here is the part of this story that changes everything. On Monday, February 2nd, 2026, just 3 days after the silver crash, President Trump walked into the White House and made a second major announcement. And almost nobody in the precious metals community connected it to what had just happened. Standing alongside the CEO of General Motors, executives from Boeing, GE Vernova, and Western Digital, Trump announced the creation of the United States Strategic Critical Minerals Reserve. He called it Project Vault. For years, American businesses have risked running out of critical minerals during market disruptions, Trump said. Today, we're launching what will be known as Project Vault to ensure that American businesses and workers are never harmed by any shortage. Just as we have long had a strategic petroleum reserve and a stockpile of critical minerals for national defense, we're now creating this reserve for American industry so we don't have any problems. The numbers: $10 billion loan from the U.S. Export-Import Bank, $1.67 billion in private capital, total seed money, $12 billion, the largest civilian critical minerals stockpile in American history. And what minerals does Project Vault cover? The U.S. Geological Survey's full critical minerals list, more than 50 minerals, including silver. The stockpile explicitly includes aluminum, antimony, copper, germanium, silver, and zirconium, among others. Trump made it explicit. We're not just doing certain minerals and rare earths, we're doing everything. The companies participating to fill this reserve include General Motors, Stellantis, Boeing, GE Vernova, and Google. Commodities traders, Hartree Partners, Traxys North America, and Mercuria Energy Group are handling purchases. Treasury Secretary Scott Bessent called it a national security emergency. A critical mineral consultant directly involved in the program stated, "Project Vault is a clear signal that U.S. critical mineral policy has moved to deployment. It says unequivocally that secure supplies are now treated as strategic infrastructure for our economy and defense industrial base." A legal expert from Baker Botts who analyzed the program described what this means for the long term. The federal government is preparing to behave like a repeat buyer, market stabilizer, and strategic counterparty, particularly where China's dominance in mining and processing creates price and availability risk. Let that sink in. The U.S. government is about to become a repeat buyer of critical minerals, including silver, at scale. Now connect the dots between these two Trump announcements. Announcement 1, Kevin Warsh as Fed chair crashed the paper silver price by wiping out leveraged speculators who had built positions on the dollar debasement narrative. Announcement 2, Project Vault, committed $12 billion of government and private capital to stockpile physical critical minerals, including silver. The paper price was sent down. The physical stockpiling was launched simultaneously. Who benefited from cheaper silver in the days following the crash? Industrial buyers who needed physical metal, government programs acquiring stockpiles, long-term physical holders who saw the paper panic as an entry point. Who got hurt? Leveraged retail traders who had chased the parabolic rally with paper contracts and ETFs. This is the bifurcation made visible in real time. Two things happened simultaneously in the silver market. The paper price experienced its worst crash in 46 years, and the United States government launched its largest civilian critical minerals stockpile in history, with silver explicitly included. These are not separate stories. They are the same story, told from two different angles. Here is what the crash did not change. Silver's supply deficit is now in its sixth consecutive year. The Silver Institute forecasts a deficit of 67 million ounces in 2026 alone. Mine supply cannot respond quickly because approximately 75% of silver is produced as a byproduct of other metals, copper, zinc, lead, and production decisions are based on those metals' economics, not silver's price. Industrial demand is not slowing. Solar photovoltaic manufacturing consumed 29% of all silver industrial demand in 2024, compared to just 11% in 2014. Electric vehicles consume 67% to 79% more silver than traditional cars. AI data centers require silver-plated connectors and silver-sintered thermal materials to cool high-power GPUs, demand that simply did not exist 5 years ago. In 2024, the United States was entirely reliant on imports for 12 critical minerals and imported 50% or more of 29 others. That is the vulnerability Project Vault is designed to address. China moved first. On January 1, 2026, weeks before either Trump announcement, China implemented new silver export controls, restricting exports to large, state-approved companies meeting stringent production thresholds. China effectively elevated silver from a commodity to a strategic material, mirroring what it did with rare earths. Now the United States has responded with Project Vault. A geopolitical competition for physical silver is now openly underway between the world's two largest economies. The market reaction to Warsh's nomination told you something important. Not about silver's future, but about who was in the market. The investors who panicked and sold were leveraged paper traders, people who had bought silver futures and ETFs with borrowed money, betting on a short-term narrative. When that narrative changed in a single afternoon, they were forced to sell. All of them. At the same time. That is why the crash was 31% in one day. The investors who bought on the way down were industrial users who need physical silver to manufacture products. Solar panels, EV batteries, AI servers. They do not care about the Warsh narrative. They care about delivery. Silver ETF holdings fell for 7 consecutive sessions following the crash. Paper holders were exiting, but physical premiums remained elevated. Refineries that had paused buying due to squeezed margins began cautiously re-engaging as prices stabilized. And by February 2nd, 2 trading days later, gold had already recovered more than 3%. Silver had bounced 5.3%. The panic sellers locked in losses. The patient holders did not. Warsh himself is expected to begin rate cuts in the second half of 2026, which would historically be bullish for precious metals, as lower rates reduce the opportunity cost of holding non-yielding assets like silver and gold. The crash removed the speculative froth. What remains underneath is 6 years of supply deficits, surging industrial demand, a government stockpiling program, and a geopolitical competition for physical metal between the US and China. Here is the truth that the terrifying headlines are hiding. Trump's Warsh announcement did not destroy silver. It destroyed the speculative narrative that had been layered on top of silver. The underlying asset, the physical metal, did not change. The solar farms still need it. The EV factories still need it. The AI data centers still need it. The US government just committed $12 billion to stockpile it. And China has already classified it a strategic resource. When the President of the United States walks into the White House and launches the country's largest civilian critical minerals reserve, with silver explicitly on the list, that is not a bearish signal for silver. That is the most powerful institutional endorsement a commodity can receive. The paper crash gave 2 types of investors 2 completely different experiences. The leveraged paper traders experienced catastrophic losses. They were in the wrong type of silver, at the wrong level of risk, for the wrong reasons. The physical holders experienced a temporary decline in the paper valuation of their metal, while sitting on assets that the U.S. government simultaneously declared strategic enough to stockpile with $12 billion. Ask yourself one simple question. If silver was truly finished, why is the United States government spending $12 billion to stockpile it the same week it crashed? The answer to that question tells you everything you need to know. The institutions are not panicking. They are positioning. The U.S. government is not selling silver. It is buying. And the industrial users who need physical metal for the AI revolution, the green energy transition, and the EV build-out are not canceling orders. They are locking in supply at lower prices. The screen showed you a crash. The vault is telling you a different story entirely. Own the reality, not the panic. Stay informed, stay positioned, stay ahead.